Rate cuts with rising prices? That quietly shrinks your savings, and it just happened.
The Fed's quarter-point cut arrived alongside hotter price projections. In 30 seconds, I'll give you 3 numbers to check so you stop losing money by saving.
Rate cuts while prices are rising? That combo quietly shrinks your savings, and it just happened. The Fed cut a quarter point while projecting hotter inflation ahead. Now, if your cash sits in a bank account that pays less than inflation, well, you're losing purchasing power, not just one day, but every day. In the next few minutes, I'll give you 3 numbers to check today so you stop the bleeding. I'll show you where the wealthy hide and how they hide from this transaction. I'm Dave Seymour, ex-firefighter turned private equity fund manager. I've watched this pattern for decades, and when policy saves the system, savers pay the price. Here's the big idea. Rate cuts into rising prices don't rescue your wallet. They raise asset prices and erode cash. So you need income that fights inflation, not a balance that melts. Let's start with number 1, your bank interest rate versus inflation. Open your banking app. Go on, do it right now. If your APY is under the latest inflation rate, your safe savings account, well, it's losing ground. A dollar that earns less than price increases becomes 80, 90 cents in real life. Groceries, rent, insurance, everything climbs while your cash doesn't keep up. Number 2, core prices versus your wage growth. Most people look at their wage increase and they feel pretty good, 3%, maybe 4%. But if core prices are running hotter than your raise, your take-home power went down. This is why budgets feel tighter even when the paycheck is bigger. You didn't do anything wrong. The math is simply working against you. Now, number 3, the income your investments pay versus where rates are headed when policymakers telegraph more cuts while admitting stickier prices. Investors, well, they chase the yield. That chases asset values higher and pushes yields lower. And if you're buying assets with thin yields just because, well, that's what everyone else is doing, you're volunteering your future pain when repricing shows up. And it will. So what does this mean for your money today? First, accept this truth. You can't outsave policy risk with low yield cash. You just can't do it. You need cash flowing assets that adjust with reality. Second, stop thinking the market as one blob. There's the paper market, fast, crowded, emotional. And then there's the productive asset market, real things that people pay for monthly because they need them to live and to work. Third, design a simple plan. Keep a true emergency fund. Move excess cash into assets that produce income and hedge inflation. Favor durability over drama. Cash flow first, growth second, story last. Let's talk about where the wealthy quietly move when this playbook shows up. They move to real income producing assets, things like apartments that people rent, where demand holds when buying homes gets harder. When financing costs fall but prices keep rising, buying a home doesn't magically get easier for families, so more people, well, they rent. Higher occupancy pressures rents. Rents support values. Income keeps you alive. Appreciation is gravy. Now, this does not mean buy anything with a roof. It means audit deals by cash flow, cap rate, debt terms, and operator quality. It means stress test rent, vacancy, and expenses. It means you never bet the farm on one shiny object. Here's how to think about it in plain steps. Step 1, run the household math. Know your monthly burn rate, your true emergency reserves, and how much idle cash is actually melting. Step 2, set a cash flow target. Pick a monthly number that would change your stress level if your job got shaky. And then number 3, use a simple filter. If an asset can't show you believable income in writing with assumptions you can understand, pass. If it relies on perfect conditions, pass. If it throws off cash under conservative assumptions, well, then you want to learn more. Step 4, ladder in, don't leap. You don't need millions to begin. You need a plan, patience, and partners who eat their own cooking. I'm not here to sell you hype. I'm here to teach you how to stop the silent loss and build financial indestructibility one cash flow brick at a time. So let's recap your three numbers today. 1, your bank interest rate versus inflation. Bank rates are lower, that's a loss. 2, your pay raises versus price increases. If prices outrun wages, adjust your plan. The income your investments pay versus where rates are headed. If yields are too thin for the risk, wait or look elsewhere. You deserve simple, strong money. Money that doesn't panic when headlines do. Money that buys back your time. This is education, not investment advice. Dave Seymour for Legacy Alliance. Wall Street plays games. Real cash flow plays defense and it wins. Now, if you want to discover how to be financially indestructible, click on the next video here. I'll meet you there. Bring your bank APY in 3 minutes.